our well. Before we begin, I would like to share a few housekeeping items. As we are aware, this webinar is being recorded for future reference. Participants will remain on mute throughout this presentation, and questions may be submitted through the Q&A or chat function on this webinar. We will get an opportunity to address as many questions as possible during the question and answer session at the end of this webinar. If you experience any technical issue, kindly use the chat function for assistance and we'll be able to offer the necessary assistance. Good, so for those joining us for the very first time, Jubilee Asset Management is a licensed fund manager by the Capital Market Authority, committed to helping individuals and institutions achieve their financial goal through professionally managed investment solutions. Our product suites include solutions such as the famous Jubilee Money Market Fund in Kenya shillings, the Jubilee Money Market Fund in USD, the Jubilee Fixed Income Fund in Kenya shillings, the private wealth offering, segregated mandates. So for us to have a proper perspective, the global economy continues to experience a significant shift driven by a number of factors. This includes changes in interest rates across major economies, inflation trends, and central bank actions that are currently happening, geopolitical events and their impacts on capital markets, emerging opportunities across different asset classes. All these developments often feel distant, but they are direct influencing our investments, our returns, our borrowing costs, exchange rates, and market opportunities here in Kenya. And so our today's discussion will therefore focus on translating these global trends into practical insights for our investors. Ladies and gentlemen, it's now my humble pleasure to introduce our speakers of the day. I want to introduce Alvin Ngure. Alvin Ngure is a senior investment analyst in the investment department at Jubilee Asset Management Limited. In his roles, he focuses on investment research, market analysis, and the evaluation of economic trends that influence investment performance. On day-to-day, he provides insights that supports sound portfolio management and informed decision-making. So Alvin will be our first speaker and presenter. And now allow me to also introduce our second speaker for today's webinar, Rita Nyairo, who is also a senior investment analyst in the investment department at Jubilee Asset Management. And she's involved in analyzing markets, developments, economic conditions, and investment opportunities across various asset classes. This helped in translating complex market dynamics into practical insights for investors. So at this point, I want to take this opportunity and invite our speaker. Welcome.
Thank you, Willie, for the introduction, and good morning again to the audience, and welcome again to this webinar. So, as Willie has highlighted, the webinar for today covers global economic trends and what these mean for your investments, specifically in Kenya. And just to touch in terms of an overview of what we are covering in this particular presentation that we have prepared for you today. One, we'll look at the global macroeconomic review and outlook. Then secondly, we'll move on to the Kenya macroeconomic review and outlook. Then thirdly, we still feel in our view that the impact of the conflict in the Middle East continues to remain relevant from a global and also a Kenya perspective. So we'll also touch on that, and then move on to discuss the performance of the Jubilee Asset Management funds, as well as the investment strategies for the same, and then highlight our key takeaways from this session. Therefore, moving on and starting with the global macroeconomic review and outlook. So starting with what you're seeing in terms of global growth. So global growth is expected to moderate in 2026 as a result of the geopolitical uncertainty, as well as inflationary pressures re-emerging. And what you are seeing in terms of latest projections is that we expect global growth to moderate to 3% in 2026. And this is from a level of 3.5% in 2025. And this assumes a scenario where geopolitical tensions in the Middle East are short-lived. In a scenario where we see prolonged conflict, we see projections from the World Bank indicating that this growth level could decline significantly to just 1.3%. So that continues to remain in focus. Then in terms of headline inflation from a global perspective, latest projections show that that is expected to increase to 4.4% in 2026. And this is from a level of 4.1% in 2025, before falling back to 3.7% in 2027. And this is, of course, largely driven by higher energy prices. And then also looking at it from a scenario where we see prolonged energy market stress, this could raise global inflation by an additional 0.5%. So those two macroeconomic indicators continue to remain in focus. And even as major global central banks look to adjust their monetary policy stance, which is what we have seen since this conflict in the Middle East began. We have seen major central banks adjust their monetary stance towards a more cautionary approach, them being mindful of the moderation in global growth and also an increase in inflation that is expected. So latest, we've seen the US Central Bank, that's the US Federal Reserve, hold their policy rates steady at a range of 3.5 to 3.75%. We've also seen policymakers from the same central bank indicate that we could see at least one policy rate increase in 2026. We've also seen market expectations indicating that this policy rate increase could happen as soon as September of this year. We've also seen policymakers from the US Central Bank revise their inflation forecasts higher to for 2026 and also for 2027. In the case of the European Central Bank, which is another major global central bank, we've already seen them move towards raising policy rates. And they did this in June by raising policy rates by 0.25% to 2.4%, with policymakers for that particular central bank emphasizing their commitment to making sure that inflation remains or moves towards their 2% medium-term target. In the case of the Bank of England, which is another major global central bank, they held their benchmark rate steady in June at 3.75%. And this is as policymakers for the Bank of England looked at easing inflation against continued uncertainty that continues to be seen in the global energy markets. So we expect this cautionary stance by major global central banks to be the case going into the second half of the year. And just to also highlight in terms of the downside risks that remain in focus for going into the second half of the year, this includes prolonged conflict in the Middle East, which will cause further disruptions to energy flows, goods, trade logistics, including maritime and air transport. And in addition to that, also persistent trade policy uncertainty, and this particularly being driven by a shift in US trade policies. That would be it in terms of the global perspective. Next, we can move on to the Kenyan macroeconomic review and outlook, and invite my fellow panelist, Rita, to take us through that. Thank you.
So, thank you, Alvin. So, bringing it home to Kenya, I think the short version, just in summary of what I'm about to highlight, is that Kenya is holding up well, though it's not immune to what's happening abroad. So our economy is expected to grow by about 4.9% this year. It's a little bit slower than earlier hoped for or earlier projected. And mostly this is stemming from the ripple effects from the Middle East. But if we compare or do a comparison with the global average of 3%, we still see that the 4.9% growth is still faster in comparison to the global growth. So Kenya still remains one of the more resilient economies in the region. If we look at the prices, inflation specifically, we did see prices pick up in the recent months, with inflation rising from 4.1% in April to 6.7% in May, year on year. And mainly this was due to the high fuel and transport costs. However, recently, I think the encouraging news is that inflation has already started to ease, falling to around 6.4% in June. And more importantly, it has remained within the central bank's target range of 2.5% to 7.5%. So the government measures, including lower fuel taxes and also the reduced electricity tariffs, are sort of helping ease the price pressures. So against this backdrop is the central bank has kept its policy rate unchanged at 8.75%. And this reflects the confidence that inflation remains under control while also supporting the economic activity. So we continue to see healthy growth in lending to the private sector, which I think is another positive sign for the economy. So the key takeaway from this is that, while we have these global uncertainties, which will remain for a period of time, Kenya's economic fundamentals continue to hold up well. So growth remains solid, inflation is moderating, and also policy makers are taking more of a measured approach. And overall, I think this provides a stable environment for investors. If we move on to the currency and FX reserves, which I think most of you are keenly looking at, especially on the exchange rate. So the shilling is expected to stay steady, close the year somewhere around 130 to 132 to the US dollar. So why we are confident of this is because Kenya has built a strong cushion of foreign reserves. So just to explain the foreign reserves, so just think of foreign exchange reserves like a household's emergency savings account, but now for the whole country. So the bigger the account, the better we can weather a shock. And that account has grown dramatically, from $8.5 billion a year ago to a record high of nearly $14 billion today. So if you can put it in another way, that cushion now covers about 6 months of everything that the country needs to import. I think the required minimum is around 4 months, so we are sitting comfortably above it. So on top of that, is that Kenyans living abroad continue to send money home, around $5 billion over the past year, which again further supports the shilling. So I think the takeaway from this is that the shilling has very, very strong shock absorbers. And I think this is very important to how matters on how you look at your investments. If you look at the market, moving on to the next slide, on the fixed, specifically on the fixed income market. So we have seen that the interest rates have been rising this year. So if we can see the chart on your left, and you compare the rates at the end of March with those at the end of June, you are able to see that they have moved noticeably higher. So in the most recent government bond auctions, we have seen investors demanding for higher rates, and because they are pricing in that extra uncertainty in the markets. So on top of that, we also have the government's borrowing plan for the 2026-2027 financial year, which is larger than last year's, which means that more bonds will be on offer. And also, given the fact that we also move to an election period, we will start seeing investors seeking a little more return for their money. So all of this summary, it all points sort of in the same direction, sort of a gentle upward pressure on the rates the government pays. But for you as an investor, it also implies stronger earning opportunities for the funds and for what you're investing in. So we'll move on to the next section on the Middle East and how it reaches you. And Alvin will be able to take you through this.
Sure. Thank you, Rita. And starting off with, yes, the impact of the Middle East conflict. So this continues to evolve, similar to a similar scenario or state of affairs compared to what was there during our previous webinar. And what we had highlighted then was a scenario framework in terms of the global oil market outlook as a start. And what we've seen since then is that oil prices have fallen from their peak of levels above $100 a barrel. However, following renewed hostilities between the US and Iran, the conflict continues to create a risk of renewed supply disruptions to oil, and this, of course, leading to high inflation expectations. In terms of the scenarios, we highlight 3 scenarios: de-escalation, prolonged disruption, and severe escalation. And just looking at the de-escalation scenario, we estimate this chance to be at about a 30% level, meaning that this will result in a low disruption to markets in the global economy. And with the oil price level under this scenario being between $70 to $80 a barrel, levels where we had seen it drop to before the renewed hostilities, and this lasting between 1 to 3 months. And in terms of how it's characterized, this would be characterized by a lasting ceasefire, safer shipping through the Strait of Hormuz, and recovery in oil production. And in terms of the implications, it would mean that we see inflation easing and global economic growth remaining relatively stable. In a prolonged disruption scenario, which we put at a 50% chance, so we estimate this to be the most likely scenario going into the second half of the year, and where we see oil prices trading between $80 to $100 a barrel. And that's where it currently is following the renewed hostilities, and this lasting between 3 to 9 months and being characterized by improved oil flows. But at the same time, you're seeing occasional attacks happening there in the Middle East, as well as shipping delays and higher insurance costs continuing. And the implications here being that inflation remains higher for longer, and oil importing countries face slower growth and also higher inflation going forward. In the severe escalation scenario, which we estimate to be at a 20% chance, so low chance, but this would have a high impact and in terms of the implications on the markets and global economy. And under this scenario, we would see oil prices going back above $100 a barrel, where we had seen during the few months ago, and this lasting over a 6 to 18-month period, and characterized by a prolonged closure of the Strait of Hormuz and further damage to oil infrastructure in the Middle East. And the implications here being that we see a sharp rise in inflation, we see central banks moving towards retaining policy rates where they are, or even moving towards raising policy rates in order to address this inflation shock. And also we see global growth slowing in a material way. The key takeaway here being that the partial recovery remains the base case. However, given the renewed hostilities, we could see oil prices rise sharply again, should this cause shipping oil production disruptions to even worsen from how they are as of this moment. Then next, just looking at how the transmission effect, how this translates into the Kenyan economy. This shock will see inflation fast rise within the Kenyan economy, and then this may be again followed by adjustments in the foreign exchange, Kenya shilling against the major currencies, as well as interest rates, which we've already seen from what Rita highlighted, that we've seen an upward adjustment in interest rates. In terms of where we stand as of the midpoint of the year, projections on GDP growth are currently at 4.3 to 4.9% based on consensus projections, and a moderate level of growth is expected with the higher energy costs weighing on household consumption, business margins, and private investment. Then in terms of inflation, we've seen this drop down from 6.7, the peak for the year in May, to 6.4% in June. And we've seen inflation accelerate from early in the year, of course, driven by this higher fuel, transport, and food costs as well. In terms of the central bank rate, the central bank moving towards maintaining their current monetary policy stance by holding the central bank rate at 8.75%. And them doing this deliberately in order to, as Rita has highlighted, to balance slowing economic growth against rising inflationary pressures. And then in terms of the current account deficit, the projection currently standing at 3% of GDP, with higher oil prices expected to increase Kenya's import bill and widen the current account deficit. From a transmission perspective, we see this happening through 4 steps, which I'll highlight. So 1, you have the global energy shock, and this leading to the higher global oil prices, rather increasing Kenya's petroleum import bill, and then moving on to raise domestic fuel prices, which we have seen happen since this conflict began. Then you also have within this elevated costs of shipping and logistics, which then go on to amplify imported inflation. Then secondly, you have the inflation pass-through effect. And here you have the higher fuel prices quickly feeding into transport, electricity, and logistics costs, which we have seen since the conflict began. Then you also have increased costs in relation to production and distribution in the case of manufacturers, and this will then go on to raise food prices in the economy and also increase the risk that we see broader inflation persist within the economy. Next, third, you see the central bank coming in terms of the monetary policy. Specifically, they'd be trying to respond to a scenario where we are seeing rising inflation, and this approaching the upper end of their preferred target range of 7.5%. And you also have exchange rate pressures, which are likely to arise, due to higher import demand and also external uncertainty. Then lastly, you have foreign exchange pressure, where you would expect that given the higher oil prices, you would be expected to see higher increased demand rather for dollars in the domestic market. And this is largely to finance fuel imports and also due to the widening external financing needs due to other imports required in the economy as well. And you also have a stable reserve position and resilient remittance flows, which have worked to limit pressure on the Kenya shilling, although a scenario of prolonged geopolitical tensions continue to remain a key downside risk. Then moving on to the macroeconomic impact on Kenya to geopolitical shocks, I'll invite my fellow panelist, Rita, to take us through this and also the next slide, which also touches on Kenya. Thank you.
Okay. So if we look ahead, and I'll just bring in what Alvin has alluded to in the previous slide. So our biggest risk that we're currently monitoring is the price of oil. And the reason why is because when oil price rises, fuel becomes more expensive, and this tends to put pressure on inflation and also the shilling. And then in turn, it also tends to influence the economic growth and also the interest rates. So today, I think we're starting from a position of strength. The economy is expected to grow to by around 4.9%. Inflation is at 6.4%, and also the central bank rate remains at 8.75%. So we see three possible scenarios. First is our base case, and which we think is the most likely outcome, is that oil prices remain broadly where they are. In that environment, we would expect steady economic growth, inflation to remain well contained, and also the interest rates to stay relatively stable. And this is the scenario that we are planning around. In the best case scenario, oil prices decline. That will ease inflationary pressures, support stronger economic growth, and also eventually create room for lower interest rates. The downside risk is a sharp and sustained increase in oil prices. In that case, we would expect higher inflation, some pressure on the shilling, slower economic growth, and also potentially higher interest rates as the central bank responds. However, I do think that Kenya is in a stronger position than in the previous years, with a healthy foreign exchange reserves and also a more stable macroeconomic environment, which should help cushion the impact. So I think the key takeaway from all this is that our outlook still remains positive. We expect the base case to prevail, and also while the external risks remain. However, from all this, Kenya is still well positioned to navigate them. The impact of this on the fixed income market is that investors are demanding higher interest rates to lend, and this is expected to remain relatively high. I think based on the reasons that we had alluded to in the previous slides. Also, I mean, given the moving on to, I mean, the new financial year, the borrowing plan, which is higher, significantly higher, and also as we approach the next election cycle. So our outlook for this is that bond yields are expected to remain relatively high, while markets continue to monitor the inflation and also the global oil prices and also future CBK monetary policy decisions. So now from all this, I think we'll move on to how this now impacts the funds that you've invested in. And I'll open up the floor to Alvin.
Yeah, thank you, Rita. And to start us off, we have a look at the Jubilee Money Market Fund, the dollar money market fund that is. And just to speak on it from a performance perspective, what we have seen through the first half of the year is that the fund has continued to maintain its outperformance against the benchmark. As you can see on the chart on your left, the dollar money market fund generating a yield of 5% on average, which is 1.4% higher compared to the benchmark average of 3.6%. In addition to that, we've also seen currency diversification being a positive for investors in this particular fund, given that we've seen the US dollar, while it has held steady against the Kenya shilling, it has appreciated against other major global currencies such as the pound, the euro, and the Japanese yen. And we've seen the dollar index, which is reflective of the performance of the dollar against these major global currencies, gain 3% on a year-to-date basis. And in terms of the investment strategy, just highlight what you may have already seen. The money market fund invests in dollar-denominated short-term fixed and floating rate debt securities issued by sovereigns and corporates in Kenya or offshore. In terms of the investment objective, the fund aims to maximize current income, achieve a competitive level of return through investments in high-quality dollar-denominated short-term money market and debt instruments. And this is also to ensure consistent liquidity and capital preservation. In terms of how the strategy has evolved, given how we've seen the macroeconomic environment evolve, we've seen the fund proactively reposition its portfolio, and this is in an effort to enhance capital preservation and also ensure income generation, which you can see has happened through the first half of the year. And we expect this to also sustain going into the second half of the year, given that the strategy continues to be well positioned for the current macroeconomic environment. And specifically, we've seen capital being selectively allocated to higher yielding short-term money market instruments and sovereign securities. And this has allowed the fund to benefit from the restrictive monetary policy setting. And in this case, what we are seeing from the US central bank. And this repositioning has helped in terms of improving the portfolio's resilience to interest rate volatility, and also has helped in terms of sustaining the fund's outperformance relative to the benchmark. The other thing we'll touch on in relation to the dollar money market fund on the next slide is in terms of how the fund's return evolves as the interest rate cycle evolves. And what you'll see on the chart on your left is an average rate of the dollar money market fund yield. And that's the line that is highlighted in red. And the other one being the US central bank policy rate. And you see that as it evolves, the fund continues to generate strong and steady returns, even as monetary policy rates have been held steady, specifically by the US central bank. And why this continues to be the case is due to a number of reasons, which we have highlighted here, and I can just touch on briefly. One, typically your money market fund, the objective of that fund is to grow your savings by investing your money in safe and short-term instruments that earn interest. So in a scenario where you see an adjustment in the interest rate cycle, as you can see here on the chart on the left, between 2024 and 2026, you'll have new funds coming into the money market fund, which will earn the current interest rate. Then thirdly, you also still have funds that have already been invested within the fund that are earning interest at the older rates prior to reinvestment upon maturity at the current interest rates that prevail in the market as the interest rate cycle evolves. And with this basically means that your earlier savings keep earning the higher rate that they had started with prior to reinvestment upon maturity. The overall effect of this is that you'll see your returns within this fund adjust on a gradual basis. And this is as the old and new savings blend, and they are reinvested and invested at the current rates. and the expectation is that you'll see your returns adjust gently rather than seeing a sudden move in interest rates, in the interest rate and return level, so to speak, that is being generated for investors in this fund. And overall, it's just to highlight that your savings will continue to earn a steady rate of return, even in scenarios where we see interest rates rise or even fall. And combine that with the investment strategy that we have in place, we expect the return level to continue to remain strong and steady. Next, we highlight the same on the Jubilee Money Market Fund Kenya Shilling and Fixed Income Fund Kenya Shilling, which Rita will touch on. Thank you.
Okay. So for these specific funds, investing in the shillings, Kenya shillings, the story is just as strong. Both of our Jubilee Money Market Fund and also our Jubilee Fixed Income Fund have consistently outperformed their benchmarks. So with interest rates still at attractive levels, we are taking the opportunity to lock in these high yields through safe, high quality fixed income investments. And this tends to position the fund to continue delivering competitive returns, even if interest rates decline in the future. So how this is of benefit to you? So your money is pooled with that of other investors and invested in a diversified portfolio of carefully selected fixed income investments that generate regular interest income, and this helps your investments grow over time. So I think just if we move to the next slide, and also I think addressing one of the questions that have been asked. So I can see if interest rates change, why doesn't the money market fund return change immediately? So I think to address that particular question now, so if, let's say if you invest in the fund today, we will be investing your money at the interest rates currently available in the market as of now. And at the same time, we also have other investors who had placed their money in the fund, let's say 6 months or even a year ago, when interest rates were different. So the fund always has a blend, as Alvin had alluded to. It has a blend of older investments and also newer ones. So as the older investments mature, we reinvest that money at the prevailing market rates. And then because of this, you'll tend to see that the return for the fund doesn't adjust sharply whenever the interest rate moves. So instead, you'll see that the returns adjust gradually over time, still providing that stable and consistent performance that our investors tend to value. So if you look at the chart on your left, so you'll be able to see, as market interest rates begin to decline, you'll see that the fund's returns have also started to come down. But the difference is that they do so gradually rather than falling sharply. I think that's the benefit of having a diversified portfolio made up of investments entered into at different points of time. So the same principle also applies for the fixed income fund, which you'll see on the next slide. So you'll notice that the returns have actually been higher, and that's because the fund tends to invest a larger portion in longer term fixed income investments, and this allows us to lock in attractive interest rates for longer. And then the remaining portion is invested in shorter term instruments, and this allows us to meet, the client withdrawals while also keeping the fund liquid. So we are ready to take advantage of better investment opportunities whenever they arise. So all of this in summary, I think we'll have the key takeaway session that will be explained by Alvin.
Sure, and thank you, Rita. And yes, so just to close the presentation, we'll highlight what the key takeaways in our view would be, and what this means for investors, of course, in relation to the topic that we're discussing for this particular webinar. Our view is that investors should stay defensive and diversified, and also look to capitalize on attractive fixed income yields. As you've seen, yields are more attractive compared to where they were earlier in the year. in an effort to navigate this elevated global uncertainty. So first is on what we've seen on global growth. Global growth is slowing, and we've also seen risks are rising, with growth expected to moderate in 2026, given the inflationary pressures re-emerging, and this largely being driven by higher energy prices. And the biggest risk to markets remaining a prolonged conflict in the Middle East, and this causing further disruptions in terms of oil supply, and this, of course, resulting in high inflation and slower global growth. So that will continue to remain in focus going into the second half of the year for investors. Secondly is on Kenya. So Kenya continues to remain resilient, but not immune, as we've highlighted in earlier sections of the presentation, with the economy expected to grow at a moderate rate of 4.9%, this being supported by domestic demand and relative macroeconomic stability. But at the same time, you have the higher oil prices, which could lead to a rise in inflation, a widening of the trade deficit, which may have an impact on the shilling, and also this could also have an impact in terms of economic activity going into the second half of the year. Thirdly is on the external buffers, which Rita touched on, which continue to remain strong for Kenya, and this is expected to support stability, macroeconomic stability within the economy, and this is in the form of robust foreign exchange reserves, strong remittance inflows, which continue to underpin the shilling stability, and these buffers providing protection against global shocks, although, as we have highlighted, the prolonged elevated energy crisis continues to remain a key risk to the Kenyan economy. In terms of investor implications, lastly, our view is that higher interest rates and bond yields continue to create attractive opportunities in the Kenyan money market and fixed income space, which the money market funds and also the fixed income fund for Jubilee are well positioned to take advantage of. Secondly, is that investors should remain diversified and maintain liquidity, and also consider US dollar exposure as a hedge against this global uncertainty. Thirdly, would be in terms of active portfolio management. This continues to remain key and critical, and this is as the geopolitical and macroeconomic environment continues to evolve. Markets continue to respond to these changes on an ongoing basis, and this would be largely being the factors that are leading to these changes being inflation, oil prices, and the central bank monetary policy decisions. So those continue to also remain in focus. And I think with that, we've come to a conclusion of our presentation today, and I can hand it over back to you, Willie. And thank you again to the audience for tuning in and listening in. Thank you.
Wow. Thank you, Alvin and Rita, for that very, very insightful presentation and giving us a comprehensive overview of both our macro and micro environment and what this means for our investors. Very, very impactful, and thank you very much. We will now be moving into the question and answer session. I can see questions are streaming in fast and furious. I will want to now just check and ask the questions that have come through the platform. And I want to maybe just start with a question. I can direct it here to Rita. There's a question: are the money market fund return going to go higher this year? And I think we will try to combine the question, because I'd also seen another question, someone asking how the elections of next year is impacting the investment. So maybe you can try to answer that question in that combined way. Welcome, Rita.
Okay, so thank you for that. So to address the first question on how the money market fund returns, if they're going to go higher this year, so we don't wouldn't promise a direction on whether the returns will go higher or not. But the setup, or rather, given the current environment, I think it's sort of supporting that direction. Government yields have been under upward pressure this year, and when the government tends to pay more, our funds even earn more. So I think to add on that is that also the fund holds a blend, as we had said, it holds a blend of older and also the new investments. So when the returns move, so we'll see that the returns tend to move gradually as opposed to that sudden jump in the returns. So if the rates rise, the market interest rates rise, we would expect a steady climb rather than a spike in the return of the fund. And that same blend tends to cushion the fund if the rates decline.
All right. Thank you, Rita, for that very clear statement. And maybe I can direct this question to Alvin. There's a question: what are the key strategies that Jubilee Asset Management is putting in place to protect our money from being hit by the global and local shocks?
Sure. Thank you, Willie, for that question, and a very relevant question. As you have highlighted, the strategy definitely is evolving, and this is to ensure consistent capital preservation, income generation, and also that another key thing is also to ensure that the funds continue to outperform their respective benchmarks. And I had highlighted what we are doing in terms of the dollar money market fund, but just to reiterate, the fund has proactively repositioned its portfolio to enhance capital preservation and income generation in this environment. We've seen where we have seen a shift in the macroeconomic and monetary policy environment. And we've also repositioned the portfolio such that it is able to be more resilient in terms of interest rate volatility, and also to ensure that outperformance continues to be the case for the dollar fund. In the case of the money market fund, Kenya shilling, to begin with, so for that fund, we've tactically repositioned the portfolio into higher yielding money market instruments. And as Rita had touched on earlier, we've seen an upward adjustment in interest rates, both on the short and the long end of the yield curve. And having tactically repositioned the portfolio, the fund has been able to capitalize on attractive short-term rates, and also at the same time ensuring that the fund continues to preserve liquidity, and number two, also manage interest rate risk going forward. In the case of the fixed income fund, Kenya shilling, the fund has been able to, in terms of the strategy has been to increase exposure to high yielding fixed income securities, and this is to capture the attractive rates that we are seeing both in the primary market, on the bond auctions, and also in the secondary market as well. And this is in an effort to capture attractive risk-adjusted returns, and at the same time maintain portfolio resilience against the evolving dynamics in terms of inflation and also market volatility.
Oh, wow. Thank you, Alvin, for sharing those insights. I will be trying to combine the question. There's a question on special funds. I want to direct this to Rita. Are there plans for Jubilee Asset Management getting into the special fund space, and how is that looking so far? And I want to combine that with what are your views on the CMA warning on special funds? I think you can handle the question on the special fund combined on what as Jubilee Asset Management, whether we are planning to get into the special fund space, and how does this look for us and for our investors going with the recent CMA directive. Rita?
Thank you, Willie. I think I can take that one on
Okay,
behalf
all right.
of Rita. Sure.
Thank you.
And yes, a very relevant question, given that we've seen increased interest in the market for these particular kinds of investment. I would say, generally speaking, at Jubilee Asset Management, we continue to remain active in terms of developing a pipeline of investment services that would be relevant to investors. And in that effort, we are definitely looking at this space. And we have an active effort currently ongoing in terms of bringing in something into the market that would be of relevance to investors that are interested in that particular segment of the market. I think the key thing to highlight for us would be what we aim to achieve in terms of our mission and goals for investors. And what we've seen our investors within Jubilee appreciate is having in their funds being invested in a way that ensures capital preservation, income generation, and that they are able to accumulate their wealth in a vehicle that is considered to be safe in the manner that is structured. So that continues to be an ongoing effort, I would say. And in terms of being mindful from what has come from the regulator, I would highlight that Jubilee funds, including anything that we would develop in that pipeline of investment services that we look to launch, our products are regulated by the Capital Markets Authority, and we would be, of course, looking to be within the regulatory framework of the Capital Markets Authority based on the guidelines that they provide for any particular investment structures that are currently in the market.
All right. Thank you very much, Alvin. There's a question here on money market funds. Why should an investor choose a money market fund of keeping money in a bank deposit account, yet the banks are guaranteeing the investors fixed rates? Rita, you can try to answer this for us, that why should an investor choose a money market fund of keeping money in a bank deposit, yet the bank guaranteeing the investors a fixed rates?
Okay, so I'll take that up. First, I think I will say that both of them tend to have a place and based on what they're offering. But from what we've seen, money market fund tends to do the work or work harder for you. And this I will explain in terms of points, in terms of returns, in terms of access, and also in the event of any interest rate environment. So if we look at the returns from what we are seeing being offered, so like let's say if I take the Jubilee Money Market Fund and also take bank deposit returns that we are getting in the market, is that the returns for the money market fund are significantly higher as opposed to investing in a bank deposit. The other aspect is in terms of access. A fixed deposit tends to lock your money in, and it tends to have even penalties if you want to exit earlier. But with a money market fund, it lets you withdraw at any point in time and get your money. For the other aspect is in the event of any interest rate environment. So you will see for that bank deposit where you have like a fixed rate that is locked in. If the market rates tend to rise, you will see that you do not, or rather, it will not be able to capture that interest rate environment. So while if you do this in comparison with a money market fund, which tends to hold a blend of older and also the newer investments, so returns move gently and it will be able to capture in. So like, let's say if the market rates rise, you will see that the money market fund also tends to adjust the same way, and you are able to take advantage of that change in the interest rate environment, as opposed to a bank deposit where you have a fixed rate and you're not able to take advantage of any change in the interest rate environment. So that is why I would opt for a money market fund.
All right. So our analysts have spoken. The questions are answered clearly. There is still a question here that I know we have talked about, but I think, Alvin, I just want you to shed some more light on it. That what do you expect, or do you project to see happening with the elections coming up? I think the 2027 election is a question that people are really concerned about. Our investors, how will money and rate shift, and the behavior of people and the economy? I know we have talked about it, but just shed some light on that, just to make our investors come on these aspects.
Sure. Yeah. Thank you, Willie, for that question, and to the also for to the audience for that question. I would look at it. This is definitely a relevant question in terms of political risk, and definitely becoming more relevant as we move towards the election period, which has been the case before, even during previous general elections. And from a market perspective, what we have seen in the past happen is that normally you don't see direct impact on markets in terms of what happens with the election. However, in a scenario where we see this political risk materialize to the point that it results in a disruption in economic activity, then that will then obviously have an impact on the macroeconomic indicators that we have discussed in terms of GDP, and possibly economic activity, and also the shilling. And also that then will be priced into the markets in the form of higher interest rates in the case of the fixed income market, and also lower valuations in the case of equity and the equity markets. So I would say this is something that investors would go ahead and watch closely, but not immediately price in terms of in terms of making their investments. It will be dependent on whether that political risk goes on to materialize to the point where it results in a disruption in economic activity. That will be the main focus there. However, in terms of the correlation, I would say we don't normally see a direct correlation in terms of market performance, as well as the elections, the developments around the elections, so to speak. Yeah.
All right. Thank you very much for making that very clear. I think because of time, I will only be asking Rita the final question. There's an investor here who needed clarity. What is the benefit of investing in the dollar account versus the Kenya shilling one? This is in regard, I think, to the MMF. Rita, you can handle that. Rita, you can hear me?
So if I speak on that, so both are very, they tend to offer, there really is no like an advantage point of view. But if I speak on the US dollar, holding some dollars tends to provide you sort of a hedge. And our USD money market fund gives you that option. So it's been strengthening and also beating, outperforming against the benchmark. So if we look at the Kenya shilling, which is expected to stay stable this year, thanks to the strong reserves, I will say that many clients hold a mix of both the dollar and also the Kenya shilling fund. And this is the diversification we would recommend. However, in terms of discussing which one will provide you the balance, or given your circumstances, I think we will be able to discuss this in another platform. But yeah, the dollar tends to give you a hedge, and also the Kenya shilling, which has been stable. So both have the same benefits given the current environment that we are in. So I would advise a mix of both.
Good. Thank you very much. That brings us to the end of the question and answer session. I think the message is home. Yes, we are Jubilee Asset Managers and you are safe with us. As we come to the end of today's webinar, I would like to thank our speakers here, Alvin Ngure and Rita Nyairo, for sharing these valuable insights and expertise. A loud of applause for them. I would also like to thank everyone who took time to join us today and participate very actively in this very important conversation and discussions. So thank you. Thank you very much. We have been recording this session and this will be shared after the webinar. So look out to be able to catch up with the recordings after this. At Jubilee Asset Management, we remain committed to empowering investors through knowledge, guidance, and access to professionally managed investment solutions. And that is why we say as Jubilee Group, we live free. We encourage you to reach out to our team should you wish to learn more about any of our products or investments, and we'll be able to discuss your financial journey. So thank you very much for participating. I have been your moderator, Willie Nduaci. Thank you very much, and wish you a very productive day ahead. Keep it at Jubilee Asset Management. Thank you, and have a very productive day. Asanteni.